Today we will be presenting an investment analysis of Stryker Corporation, one of the world's leading names in the medical technology.
Right, so Stryker has a diversified product portfolio that serves over 70 countries across the globe. Its two major revenue streams are from the orthopedics and spinal sector, contributing 41.3% of the revenue, as well as from the med-surg and neurotechnology sector, making up 58.7%. Stryker primarily services doctors, healthcare facilities, and hospitals. With a history of revenue growth, strong gross profit margins, and operational resilience, Stryker is poised for continued expansion in the growing global medical device market.
So our first thesis is that Stryker is a leader in growing industries with favorable market conditions. And so what that means is that up there in the middle, you can see that Stryker has the leading, or some of the leading sales percent rankings in these industries that they have their growth, their revenue segments in. So in orthopedics, the number 1, neurovascular number 2, medical surgical number 6. And that's combined with a strong compound annual growth rate. And as you can see, they outpace many of the competitors. And the reason that this is the case is because they have really competitive tactics. And one of these tactics is they find flaws in their business and they improve them. This year in 2024, they established manufacturing facilities in Mexico and Poland. And what that did was it cut costs, and it's going to lead to higher than anticipated 2025 earnings per share. And we believe it's going to lead to operating margins like C 26% in 2025. The second part of that thesis is that they have a standout financial performance that's backed by strong market tailwinds. So right there, you can see that the markets that they're in, the markets that they have their revenue comes from, are projected to grow. They have been growing. They're going to grow steadily for the next decade. And what that mirrors is their strong return on equity growth and the strong earnings per share growth. So overall, they're really poised to experience growth in the future, and they're really steady. So our second thesis is that they use a merger and acquisition focused capital allocation strategy that drives higher growth in emerging markets. The first part of that is the mergers and acquisitions that correlates revenue growth. 73% of their revenue each year goes to mergers and acquisitions, and that directly leads to revenue growth. As you can see right there, and then at the top, they acquired Bright Medical. This is an example. They acquired Bright Medical Group in November 2020, and then next year, the profits realized and directly led to trauma and extremity sales growth. Another example of a company that they acquired that led to growth is Mako. And so Mako in quarter 2 of 2024 improved some products, and it led to a 3% sales jump. And in quarter 3 of this year, Mako released a product. As you can see over there, it was a spine product, I think, and they're expected to release a shoulder product, and those profits will realize in 2025. And we believe that this will lead to surgery sales growth, robotic assisted surgery sales growth in 2025. And then the second part of that thesis is the fact that their international mergers and acquisitions facilitate emerging market expansion. So in the last decade, they acquired 54 different companies, 6 in the last year, and 2 of those were international. And they're kind of matching that with investment into foreign companies or countries like India, and this is going to give them access to emerging markets like India. And as you can see, the Indian market is growing 10 times. Kind of that's hard to see there, and that's combined with the Chinese market that's growing, the Asian Pacific market in general, and the EU market that's growing as well.
Yeah, there's some risks. Stryker currently has a debt-to-EBITDA ratio of 2.72, and that's sitting on the higher side of standards for the medtech industry, which are usually between 2 and 3. But we believe that's a temporary inflated value just because of the acquisitions Michael was talking about that Stryker expanded with earlier this year and in the last 2 quarters. So projections show that in 2025 that ratio will normalize again because profits will start coming from those acquisitions. And then the fourth risk there is just stating that Stryker has some loans outstanding, and that will be due in the next few quarters. Our mitigation for that risk is just that Stryker has a credit rating of BBB+, which just proves that they've never had a problem repaying any of these similar type loans.
Alright, so just to sum things up, Stryker is a global market leader with solid financial health, strong revenue streams, and robust growth strategy that leverages innovation and acquisitions. Its leadership in key markets, combined with future returns to growth in post-pandemic conditions, will lead to increasing profit margins and diversified market access, especially in high-demand segments like robotic surgery.
So now we have the valuation, and we're going to start with historical multiples. So as you can see, their PE is still relatively high, but it's improving compared to previous years. So in 2021 it was 57, now it's down to 40, and we expect this to continue to improve in the coming years. Their EBITDA their EV over EBITDA is solid, and their EV over revenue is also solid. And they have a downside potential of -7%, but we believe that with obviously many other manufacturing facilities, but this was just a case when they saw an opportunity to cut costs, and they did so. And so that's when we realized, yeah, it's going to improve our margins.
Just to touch on more in terms of their competitors and looking back to the last valuation there, their PE ratios kind of just above the median. Why do you think specifically Stryker think their competitors?
So Stryker has a really strong growth rate, so they're really poised well to, they're really strong in the industry right now, and they're poised to grow significantly in the upcoming years. And we believe that despite the fact that it does have a slightly above average PE ratio, it's poised to exceed this PE ratio in the future, or in terms of their profit margins, their profits in general, and their potential for expansion. So they're going to grow into this valuation, and they're going to actually exceed expectations just because they just have such a strong potential for growth.
Beyond that potential for growth, like just relatively looking at them in terms of competitors, is there any key markets they're in, or any key factors about them that you would say validate looking at the cost and some of that you have, or you would say that Stryker has an advantage in?
I think it's more so like their strategy and their like potential for expansion. So right now, again, like, despite the fact that they are really strong in the orthopedic sector, the neurovascular and the medical surgical, they have a lot of potential for growth because they're like 73% capital allocation towards mergers and acquisitions. And so in the past year, they acquired 6 different companies, and what that means is that many of the companies are going to realize growth in 2025 because of that, as has been historically shown by data. And so despite the fact that maybe they are slightly higher valued right now, they have a lot of potential for foreign expansion because of their foreign, like they acquired two international companies in this past year, and they have a lot of potential for expansion in the U.S. specifically due to the Asian populations.
So you mentioned they have high leverage ratio, so what is their debt to EBITDA? And also, is it floating or fixed? Essentially what I'm trying to ask is, are they going to benefit from the decrease in interest rate environment, or is their interest rate dependent that is fixed and there are no changes, for example?
So their debt, like it might seem like a big number right now, it might seem like scary now, but it's not an issue because Stryker has such a strong and aggressive acquisition strategy. What they do is they leverage debt to acquire those companies. And so what that means is that despite the fact that like, it's artificially inflated right now, it's going to reduce in the coming years. And once the profits from their acquisitions realize, like those statistics shouldn't be an issue. They're just going to continue to experience growth.
Cool. Yeah, one question, just in terms of valuation, I understand, and as you've definitely kind of decided it's a great business, stuff like that. So valuation-wise, why now? Why buy the company now?
So as we talked about, the profits take time to realize from their acquisitions, and they just acquired 6 different companies. So if you go back to this one, right, you can see their acquisitions over time, and they just acquired 6 different companies. And what that means is that those companies can reflect directly growth in 2025 because often acquisitions do take time to realize profit, especially inorganic and organic profits, like both of those.
Do you think that the market's already maybe priced that in, seeing as their multiple seems to be sitting? Yeah.
I don't think so. So Makos, if we're looking at there at the top right, Makos Robotics is releasing products in late 2024 and early 2025. That in combination with these acquisitions. So one of these acquisitions is I think it's Artelon, or it's Artelon and Molly Surgical, and those are they're related to soft tissue, or Molly Surgical is related to soft tissue surgery, and Mako is a really strong competitor, and it has the 2nd largest stake in the robot-assisted surgical business. And so combined with like the Molly Surgical acquisition specifically in 2024, that's going to boost profits in 2025, just due to like the improved quality of their product. So we just like think that that's a new thing that just investors have priced in because of the products.
Good.
What do they have in their pipeline and what's at each stage? So like what's in stage 3?
You mean looking forward?
Yeah. Like what's coming out in the next 5 years?
We can expect continuous acquisitions in the next 5 years.
Well, what do they have in their pipeline? Like in their product development pipeline, like stage 1, 2, 3 of FDA approvals?
I'm not sure.
They just acquired Very AI so they're going to be